Hey guys, Brian Davis here from Spark Rental. Super glad to be with you today. And I am pumped to have John Casmon with us. John is a real estate entrepreneur. He's invested in over $100 million worth of apartment buildings. John hosts the Multifamily Insights podcast, formerly the Target Market Insights podcast. He's also the co creator of the Midwest Real Estate Networking Summit. John, thank you so much for being with us today.
Hey, Brian, thank you for having me today. I'm excited to be here and happy to talk to you.
Yeah, absolutely. So, John, one of the first things that I love to ask people when they come on this show is just how you got into real estate investing in the first place. Everyone has their own unique story to that, but most of us started at the same place with not much money and not much knowledge. So, yeah, take us back to the very beginning. How you got into real estate investing?
So I've been interested in real estate investing for a long time, right? Like a lot of people interested, but didn't do anything about that interest. I really didn't know how to get started. So I remember when I was still in college, I was just thinking about like how to make money. And a lot of the people who you saw who were successful and rich own some real estate. So I was like, okay, real estate, but I had no clue how to get in it, right? Like I would grid we had a weekly paper. So we had our daily newspaper and then a weekly newspaper just for our community. And I would get that and just like circle houses and like, oh, okay, yeah, that house. I didn't have the money to invest in these houses. I didn't have a business. I didn't know how to use a hammer. Like I had no plan, right? So nothing happened with that. Me just daydreaming essentially is what it was. So it wasn't until I started my corporate career. I was working at General Motors, working in advertising and marketing, where I spent 15 years doing advertising and marketing for big brands. And when I was at GM, I was there when we went through bankruptcy and watching the news and my company on the news and my boss's bosses on the news, and it just was filled with anxiety and chaos and like uncertainty. And I just remember like, man, I hate this feeling. There's got to be another way. Like, how do I get out of this? And there was one guy who was always really happy, and that guy, he owns some real estate. So in short, it made me realize, okay, you need to start investing in real estate. I was still in Detroit, so it took me some time to exit Detroit, move to Chicago. And once I moved to Chicago, my wife and I started with a house hack. We bought a 2 unit building, lived in one unit, rented out the other. And then from there we started slowly scaling our portfolio. But as you alluded to, we kept running out of our own money. And eventually we
Right.
learned how to raise money and partner with others and ultimately got into apartment syndication.
Well, first of all, I love that you guys started with house hacking. I have house hacked myself, as is my business partner, and she's gotten way more creative with it than I have. I mean, she's like hosted foreign exchange students, and I mean, she's rented out storage space. She's done all kinds of goofy stuff. I just had some housemates, and now we get free housing through my wife's job. But house hacking is a fantastic way to start. You can use that owner occupied financing with the small down payment, the low interest rate. You can ease your way into real estate investing and get rid of your housing payment and free up all that extra income to invest in real estate. So love house hacking as a way to get into it. So yeah, tell us about how did you scale up from tell us about that, that second, third, fourth property you bought, after the house hack and just scaling upward, towards the commercial real estate that you invest in today.
Well, I think the first thing was that house hack. It was critical because it did all the things you mentioned, right? Freed up some of the capital, allowed us to reinvest, allowed us to save, but it really gave us some confidence and it made us realize, okay, this real estate thing really does work. It's not just what I've read in the books and heard other people talk about. Like I'm seeing it. So it made me want to do more of it. And the next, it was a 3 unit building where we had saved up money and invested in that. The next, it was an 8 unit building. We actually refinanced or put a line of credit on the first property to buy the 8 unit building. And at that
Okay.
point, we were ready to scale, right? So at that point, everything was working. Like we had brought on a professional management company. So I felt ready to scale, but I didn't know how. And at that point, I had to, enlist some help and talk to my friends and colleagues and mentors. And ultimately, I ended up hiring a mentor. And that really helped me get the direction of how to put together deals, how to raise money, how to structure them. And ultimately, the next deal we did was 192 units. So, and that was, with a lot of partners and whatnot, but it would not have been possible without kind of the mentorship and kind of the people in my path who kind of helped create that opportunity.
Well, I absolutely love that you went out and had the humility to get a mentor. That is something that I did not do when I was in my 20s and getting started in real estate investing. I was that like just stereotypical idiot that thought, oh, I can do this all myself. Like I'm as smart as these guys. And then, of course, lost my shirt on those first real estate investments because I was too stupid to go get help and get guidance from people who had done it before. So I ended up making all those mistakes that were totally avoidable. And it sounds like you did manage to avoid most of those mistakes.
Most of
Uh,
them.
yeah, I mean, obviously there's some things that you just have to learn firsthand by getting your hands dirty. But love that you went out, got help from people who have been down this road before. Avoid some of those roadblocks that trip up so many novice or new real estate investors. Uh, that being said, did I hear you correctly that you went from an 8-unit building to straight to an 192-unit building?
Yeah, we did, and we were general partners, and you hear people say that this is a relationship business, and I heard that for a long time, and I hear it. It makes sense. Oh yeah, you need to have brokers, you need to have property managers, of course. But when they say it's a team sport, what we're really getting at is that it's pretty much impossible to scale at that level by yourself. You have to have people on your team that can help you. And you also have to be willing sometimes to be on a team. I think I spent a year trying to find that deal and lead it by myself. But organically and naturally, I built relationships. And one of those partners, they came across a deal and they said, "Hey, we could use some assistance on a couple things here. Would you be interested in working with us?" And that's when I said yes. And that really opened up the door because being on someone else's team kind of allowed me to grow and scale with the things I was doing. We did a 28 unit deal after that, and then we did some more of our own deals. But it really helped us to be involved in a large deal in that capacity, and it helped to again build the confidence, build the credibility, and get us comfortable so that we could continue to scale. And I think that's really important for people just to recognize that it's okay to be on a team as opposed to being a solo practitioner on your own deal.
Yeah, that makes total sense. I think some people get into real estate investing because they like the idea of kind of being independent, being a maverick, being a lone wolf. But like you said, real estate investing is absolutely a team sport, and the bigger the playing field that you want to play this sport on, the more you need a team, right? I mean, you might be able to go out there and flip a house or two by yourself, or maybe with a little bit of help from contractors and stuff. But if you want to get into multifamily syndications and commercial real estate, you need realtors and property managers. You need partners to help you raise capital. You need many different contractors. You need such a wide team to do it. Yeah, I think a lot of people when they first get into real estate investing don't fully appreciate just how much of a team sport it is. So this 192 unit deal that you did, this first really big syndication deal that you did. So were you a co-sponsor on that deal? Did I understand that correctly?
Yeah, yep. We're general partners on that deal, kind of co-sponsored with the lead team.
Okay, yeah, and that's a path that I've heard a lot of sponsors take. Getting started with someone else who's a lead sponsor on a deal. It gives them practice in seeing how the deal is structured. Behind the scenes. Legally and practically. Get some traction with raising funds, but for a deal that you didn't have to put the entire thing together yourself. So that makes total sense. Can you give us a little bit of background about just how that first deal went and what you learned from it? And how did that go?
Yeah, deal went great. We hit all of our metrics, great returns for our investors and our partners. I think the thing that was interesting is actually ties into the current climate is back then we were very concerned with the market. So what was going to happen with interest rates? What was going to happen with this? And interest rates were I want to say around 5.5% at that point. So we locked in long term debt. We locked in 7 years debt. And what ended up happening was rates ended up coming down. So we had buyers who wanted to buy the property from us earlier, but because we locked in a 7 year loan at five and a quarter or whatever the interest rate was, the prepayment penalty was actually too severe to absorb the
Uh,
sale in year three and year four. So we almost had to hold it for almost 5 years before we could sell it. I think we sold in year four, but towards the end of year four. But we had to as opposed to in year 2 and 3, where we had great offers that would have absolutely helped us to exceed our investor expectations. But that prepayment penalty was big. So I think part of it was the big learning was, again, the deal itself was great, and I think we did a great job of due diligence and execution. My lesson was really you always want to have flexibility. So think about prepayment penalties, think about rate caps, think about what happens, and you want to build in that flexibility. Sometimes you do it in a way where it is giving you options to refinance. Sometimes you're doing it where you have an option to exit the deal prematurely if the offer comes up.
Yeah, the more passive real estate syndications that I invest in, the more I appreciate the importance of financing terms and that flexibility that you mentioned. 'Cause none of us know the future, right? I mean, my crystal ball is no clearer than anyone else's. So, what does that mean? It means that you want to deal with as many different outs as possible, right? As many different contingency plans, or escape routes, exit strategies as possible. Um, the longer term the financing is, the more runway you have to be able to sell in a better seller's market. The less of a prepayment penalty, or the shorter that period is for a prepayment penalty, the better. Like you said, in case a good seller's market comes along, rate caps super important, as way too many sponsors have discovered the hard way over the last year and a half, 2 years. Yeah, I certainly appreciate that. Speaking of assessing risk and mitigating risk, I want to hear about how you underwrite deals, how you approach deals when it comes to moderating risk. And then I also want to dig in a little bit about some of the specific risks you see in this market that not enough sponsors are talking about.
So we are primarily in the Midwest, right? So I'm based in Cincinnati. We like a 2-hour radius around Cincinnati. So think Louisville, Columbus, Indianapolis. Those are some of the key markets we're paying attention to and we're looking at deals in. So for us, cash flow is king, and it's first and foremost what we're looking for. But we do want appreciation. I think there's this perception that you don't get appreciation in the Midwest. That's not true. You absolutely get appreciation. It's just not at the same extent and maybe some of our West Coast markets or some of our coastal markets. But we absolutely look for appreciation as well. So there's a balance of in-place cash flow, forced appreciation through cash flow, and then forced appreciation in general. So we're kind of looking at all of those things together so we can see how do we drive that cash flow, how do we drive that appreciation, and that helps us to stay conservative, right? If the property is able to pay its bills, then we can put ourselves in a pretty good position where we have flexibility and we have options. I think when we're looking at deals, we're really taking a look at a couple different metrics. We're looking at the DSCR. We're looking at the stabilized DSCR. So once we go in and implement our business plan, where do we think that number is going to be? And then what does the demand look like on the back end? What are people buying assets like this for? Is it in the path of progress? What is rent growth looking like? We're trying to pay attention to all those different things so we can understand how much control we have. Do we want to stay in this deal short term? Do we want to stay in it long term? How much flexibility do we have? Can we, just decide when we're out? I'll give you one quick example is we've got a deal where we have a 12-year loan. So we assumed it with 10 and a half years left on it. The rate's fixed. It's under 4%. The rate's at 3.2% for
Wow.
another 10 years. But so if you go back to what I said on that first deal, that 192 unit, the problem was we didn't have options. We were locked in. We had a big prepayment penalty. On this deal, it's an assumable loan. So you can add a supplemental loan to it. So we have options to still sell it whenever we want to, because a new buyer could come in, they can add new debt to it, they can leverage it up and find it to make it work for their needs. And because our rate is so low, we think most people want to keep that loan in place and then just add a
Oh yeah.
supplemental loan. Again, so we can pay down our supplemental if we needed to, right? So we have a lot of options on a deal like that. So we can sell or we can keep it as long as we want to. And that's kind of the position you typically want to be in. You asked about the thing that people are not paying attention to. I would say that we're talking a lot about interest rates, and rightfully so. Interest rates are certainly all the buzz. But I think when you take interest rates, you add in the higher cost of insurance, where in some cases it's doubling, if not tripling. You add in, rising taxes. rising, add in overall inflation on expenses, there are a lot of people who are not seeing the returns that they were expecting to get on deals they've done over the last couple of years. When you factor all those things in together, so there's going to be a lot of opportunities. But on the same note, when you're looking at these deals moving forward, I think the cap rates are certainly going to expand because it's hard to make these deals work without factoring in all of those different components. So that's something that we're seeing more and more of, and I think you may see more of that over the next 6 to 12 months. So we're just paying attention to that and looking at that for every deal we're evaluating.
Yeah, no, that I love your answer. That makes total sense. Yeah, I've heard some similar horror stories about insurance premiums doubling in the course of a single year. Just crazy stuff. Uh, so, you mentioned that you invest for cash flow. Uh, You also mentioned that expenses are rising pretty sharply at the moment in the multifamily space. Uh, Do you see rents, rent growth has been slowing over the last year. Are you concerned at all about, that cash flow just getting pinched from both sides, slowing rent growth, maybe even a dip in rents combined with those expenses not dipping at all, and if anything, continuing to rise sharply. So how do you adjust for that when you're underwriting these deals?
I'm not as concerned with it simply because of our investing strategy. I think gives us a little bit more flexibility. So we're typically investing in B class assets where there's a value add component. So we're not just pushing rents $100 to see what we can get, right?
Right.
We're typically adding some sort of value where we already know that there's demand in the marketplace for a property to have that. Uh, Also, in the markets where we're in, for the most part, it's not cost effective to build new product similar to the kind of product we're going to be bringing out there. So we haven't had the boom of, say, Phoenix or Dallas, where you had a lot of Class A stuff built over the last 10, 15, 20 years. So some of that stuff is Class B now. In these markets, take Cincinnati, if it was built new, it's a Class A. Like that's just what it was. You're not building a B class property. So in these markets, there's demand where people don't want necessarily want to pay the luxury taxes or the luxury price for things, but they also don't want a 40-year-old outdated product either. They want a nice apartment that's affordable that they can live in. What we are seeing though is occupancy. We're keeping our eye on occupancy where that is starting to take a slight dip because some people who maybe um, were fine having their own apartment a year ago, they're now deciding to move in with a family member or move in with a friend. So we are seeing occupancy start to take a slight dip in some of the places across our portfolio, but we're not as concerned with the rent growth just because I think demand is still fairly strong. And our product is fairly unique because there's just again you can't really build it. So and I think too with renovation costs, it's sometimes hard to duplicate that. So we feel pretty good with it. It's not to say that we're obviously we're watching the market at all times, but I do think that we're in a nice spot in our markets because it's just hard to find updated, renovated B class apartments that are relatively affordable. So.
Yeah, no, that makes total sense. I mean, in our co-investing club, we invested a few months ago in a property in the Midwest where, between the acquisition costs and the renovation costs, it was going to cost around $105,000 per unit.
Mhm.
But to build a comparable property would have cost $200,000 a unit. So, you have so much protection there that you're probably going to be okay, even regardless of what happens in the market, right? And to me, that's the kind of thing that I want to look for as we continue through this very uncertain real estate market. No one knows if we're going to have a recession, when it will come, how long interest rates will stay elevated, how high cap rates will get. No one knows any of that stuff. But again, if you find ways to just protect yourself with enough leeway there, like what you guys are doing, then you're probably going to be able to just weather those ups and downs in the market. Uh, so Limited partners, passive investors can invest money with you, including non accredited investors, which we certainly appreciate. In our co investing club, that is really important to us. We will only propose deals and do deals in our investment club that allow everybody, non accredited investors included. That inclusivity is really important to us. Um, I also understand that you guys train sponsors, train people to go out and become syndicators themselves. So tell us a little bit about how that works, what you guys are doing. Yeah, what are you doing there?
Yeah, so it's interesting. Like I don't necessarily think of it as training people to become syndicators, but I guess technically that is what we're doing. The way I see it is we help people invest in multifamily, and I love the way you talked about opening the doors for both accredited and non-accredited investors because I think it's really important for people to have an opportunity to invest in an asset class that can really accelerate their wealth and their wealth growing potential. And it shouldn't be exclusive to those folks who have already made it to an extent, right? If you've got the knowledge and the funds, there's a great pathway for you to invest. So for us, what we try to focus on is helping people in one of two ways: investing alongside of us in these deals, or teaching people how to invest in multifamily apartments themselves. And that could be everything from smaller multifamily deals like the 8 unit building we had, the 28 unit building we did a JV partnership on, up to a 200 unit apartment community where you're going to syndicate it. So that's really up to the individual as far as how they want to do it. But the reason we like to teach people how to do this is to remove the barriers that can stop people from seeing success. It's also to help them understand that you have a purpose, and it's up to you to decide whether or not you want to take on this calling. But when I started raising capital for our deals, I had a big aha moment. And when I initially started, it's because I put down $130,000 that I saved for the down payment of a property. I was like, man, it's gonna take me a year to save up this kind of money again, right? And it's a lot of sacrifice to save that kind of money when you have your, two young children.
Oh yeah.
Um, and what I realized when I went through that first deal, I was talking to one of my investors, and after he made the commitment, he said, "Thank you." And it made me stop and think. And I realized that we were really providing a service because while it was my first syndication deal, I'd certainly had some knowledge and experience in the smaller deals I was doing, but this person trusted me, right? And that's what they were looking for, was someone they could believe in and trust to help them get into real estate. And that's what I was able to do for that individual. And when they said thank you, it kind of made me realize that this is a service, right? It's a service-based industry that we're providing. We are helping people, diversify their income. We're helping people get cash flow. We're helping people get the appreciation that real estate can offer without the headaches or the knowledge or the expertise that you need to be a landlord. So you can invest passively in these deals, even if you haven't taken, hours and hours and days and weeks of real estate investing courses and books and
Right.
podcasts and all that other stuff, right? So that's really important for me. And I think it's a calling for everyone listening. If you're getting this knowledge, if you're investing in real estate, if you want to be active, treat it as a calling. Help those people in your circle, right? Don't just make your money and keep it to yourself. You're not responsible for someone else making money, right? I know some people say, well, I don't want to do it because if someone loses money, I don't want to feel bad or make them feel like they listen to me and it's my fault. It's not your job to make someone do something, but you should help people become aware that they can do something. And if they want to educate themselves, there are tools. You've got your club, like there's resources available to educate yourself. And then they have to be comfortable with the risks that are involved with investing. But to not tell people or to not educate people on something that has the potential to change their lives, I think it's pretty selfish. And again, I'm not saying you got to be the advocate and go, convince everybody to invest, but I do think it's if you were my friend and you were, killing it with any investment and you retire early and I'm still working and, grinding away and I'm 62 and you've been living in Hawaii for the last 10 years and you tell me it's because you started investing in real estate and you just never shared this with me in the entire time I've known you, I would be really upset with you, right? So for me, it's more, hey, here's what I'm doing. If you're really interested, they'll tell you. I'm not. You don't have to preach it, but if they're really interested, they'll start asking you questions. So like my best friends invest with me. right? So, and they didn't invest in the first deal, but one of them did. But as they watched me, they said, "Hey, man, you were telling me about this, and I didn't quite understand it the last time, but can you tell me more?" And that's my point: is you should at least share it so people can raise their hand and decide if they want to be a part of
Well, I love that. And that is the philosophy behind our investment club as well. Educating people, inviting them to participate with small amounts rather than the typical 50 or 100 grand. Letting people kind of dip their toe in the water, spread small amounts across lots of different deals, uh, and start on that journey to financial independence, potentially retiring early. So I love what you guys are doing. Where can people connect with you if they want to invest with you as a passive investor, a limited partner, or if they want to get some of your training that's available for active investing?
Yeah, the best thing is go to our website, casmoncapital.com. We have a sample deal package on our website. So whether you want to be passive and just kind of wrap your head around some of the language, the deal structure, all that technical stuff that comes in these deal packages, you can check that out. If you want to be active and figure out, well, what should I tell people about this deal? It's a good resource to learn from there. Our podcast is there, Multifamily Insights, and we have some other resources available. So just check out our website, casmoncapital.com.
And we'll certainly link to that in the comments and show notes as well. Don, thank you so much for joining us today. This was great.
Absolutely. Hey, thank you for having me, Brian. Appreciate it.
Absolutely. Well, if you guys enjoy these conversations that we have, please rate, review the podcast wherever you listen to podcasts. Make a big difference to us. And we will catch you next Tuesday, same time, same place. Have a great week.